Every time gold prices exceed the stock market, two things occur. First, something in the economic system breaks down. Second, specific individuals become extremely wealthy. We're witnessing this right now. Let's take a closer look. In the past century, gold prices have only surpassed the stock market on 5 separate occasions. The first instance was in the early 1930s, coinciding with the Great Depression. The second occurred in the early 1970s, when we experienced severe stagflation, marked by soaring inflation, falling wages, and a significant recession in the United States. The third instance was around 2000, when the dot-com bubble burst, raising concerns about the economy and the dollar. The fourth came in 2008 during the significant financial crisis marked by a housing market crash, and worries about hyperinflation due to extensive quantitative easing. Thus, gold prices outpaced the stock market. The fifth instance began in 2020 during the pandemic. You might ask, but didn't we already see that pressure? The pandemic led to an economic shutdown that caused widespread concern. Here we are in 2025, and gold prices are once again exceeding the stock market. History may not repeat itself, but it certainly expresses similar patterns. Each time this has happened, it typically indicates bad news for the economy while some individuals become exceedingly affluent. The aim of this video is to discuss what is happening in the economy presently, and how you can discover investment opportunities for yourself. To truly comprehend what might be on the horizon, we need to examine historical context. In the early 1900s, the US was operating under a gold standard, meaning that gold was considered money. However, this started to shift during a significant financial crisis. People were running out of funds, and businesses were going bankrupt, which created concern. So what did they do? They began withdrawing money from their banks. Panic withdrawals swept across the nation, with depositors rushing to access whatever savings they had left before it was too late. Hundreds of banks, even thousands, were forced to shut down, causing the entire financial system to tremble. Back then, money was equivalent to gold. Consequently, people withdrew their gold from banks and hoarded it at home due to concerns about bank runs. Remember, during this Great Depression, there was no FDIC insurance, so if individuals withdrew their funds, banks would run out of money and collapse. Therefore, people were scared, and they hoarded their gold. Meanwhile, the US government required funds to manage bills and stimulate the economy. Remember, money was gold. This is when President Franklin D. Roosevelt signed Executive Order 6102, making it illegal to own more than $100 worth of gold. If you possessed more than $100 in gold, you were mandated to sell that gold to the US government for $2,067 per ounce. Failure to comply could lead to imprisonment. Interestingly, as soon as the US government acquired your gold for $2,067 an ounce, they promptly revalued it to $35 an ounce. This enabled the US government to enhance its wealth to cover its obligations. After that event in 1933, our monetary system transitioned from being solely based on gold to being currency backed by gold. This established a promise stating, "This $100 bill you hold is backed by $100 worth of gold." But that changed in 1971. The US government then had extensive debts. Many foreign nations expected to be paid back due to the loans extended to the US, and there wasn't enough money to fulfill those obligations. To create more money, additional wealth was needed. Remember, our money was backed by gold, which prevented the government from simply printing more money without having more gold to support it. This is when Richard Nixon temporarily removed the US dollar from the gold standard in 1971, allowing the government to print an unlimited amount of money. I have instructed Secretary Conley to temporarily suspend the convertibility of the dollar into gold or other reserve assets. That's exactly what happened. We printed more money, paid off all our debts, and supposedly resolved the issues. However, this led to an inflationary crisis as we printed excessive money without generating more wealth, resulting in a devaluation of the dollar. Prices began to rise while wages stagnated, and the economy slowed down, which led to our dollars no longer being backed by gold. Today, what we refer to as money is not underpinned by gold or any other precious metals. It's based on a promise that the US dollar holds value because it's supported by the strongest economy and government in the world. This is why there is so much anxiety when gold prices outpace the stock market. When gold prices rise, it doesn't necessarily reflect an increase in gold's value. Rather, it's indicative of the declining value of the dollar used to purchase it. Investors buy gold due to their concerns. In contrast, look at a company like Amazon. When Amazon's stock price goes up, it's typically because they are generating more value, striving for greater profits, and people are excited about future products. That's why Amazon's stock price may increase. So why would gold prices rise? Because people are anxious. To grasp the concerns at play, we need to analyze the dollar, particularly its creation in recent years. A simple way to understand this is by reviewing the national deficit. This reflects the United States government's spending beyond its financial means. Remember, the U.S. government has one primary stream of income: tax revenue from taxpayers like you and me. What we've seen, particularly in recent years, is that the U.S. government has been spending significantly more money than it has available. When a government spends more than it has, it must borrow. Where does it borrow that money? It can take loans from individuals like you and me, from foreign countries such as Japan and the United Kingdom, or from its central bank, the Federal Reserve. Despite being called the Federal Reserve Bank, it is not a traditional bank because you cannot deposit money there. It also doesn't have cash reserves, and it is not fully governmental. This is stated on their website. However, the Federal Reserve can print money and lend it to the U.S. government. Keep in mind that the Federal Reserve prints money without creating more wealth to back it. As a result, when more of this money is generated out of thin air, the value of each dollar decreases. Let's now take a look at what the national deficit has looked like from 2019 to 2025. I'll explain what this means for you as an investor, as it's essential to understand from an investment perspective. For those of you interested in investing, or wanting to become investors, I offer a free investing masterclass, where I walk you through how to get started as an investor, and discover hidden investment opportunities before they gain attention. In 2019, our national deficit was $984 billion. In 2020, during the pandemic, it skyrocketed to $3.1 trillion. In 2021, it was $2.8 trillion. And in 2022, it dropped to $1.4 trillion as things began to stabilize. However, by 2023, it rose again to $1.7 trillion and continued to $1.8 trillion in 2024. For 2025, we don't have the final numbers yet, but it's projected to be around $2 trillion. What's crucial to understand is that the size of the debt isn't what matters most. It's the ability to repay that debt. It's the real value of the debt compared to your assets. For example, if you have $100 worth of debt, is that a lot or a little? If your net worth is $2, that's a significant amount of debt. Conversely, if your net worth is $1 million, then $100 of debt is relatively minor. If the United States government carries $38 trillion in debt, the underlying concern is that our fastest growing expense is interest payments due to this massive debt. Additionally, our national debt is increasing at a pace much faster than our national wealth, which is causing investor anxiety. Currently, the Trump administration is looking to introduce changes regarding gold and cryptocurrencies to help mitigate investor worries and address economic concerns. Remember, I mentioned earlier that in 1933, it became illegal to own gold, and President FDR mandated that individuals sell their gold to the government for $20 and change. After the government seized that gold, it was revalued at $35, thus making the government wealthier simply by changing the value on its balance sheet. This situation could potentially happen again. While it hasn't taken place just yet, in August 2025, the Federal Reserve published an article discussing the possibility of revaluing the government's 261.5 million troy ounces of gold, which is currently valued at $42.22 per troy ounce. Let's do some quick calculations. If we have 261 million ounces of gold and multiply that by $422 per ounce, that equates to approximately $11 billion worth of gold on our balance sheet. The Federal Reserve is essentially asking, what if we just change the value of our gold? In the article, they proposed revaluing it at $3,300 per troy ounce. So now, applying the same math, if we assume the same amount of gold and adjust this to $3,300 per ounce, the value of our gold on the balance sheet jumps from $11 billion to around $860 billion. Instantly, the US government appears wealthier just by altering the value of this asset. The goal here is that this adjustment would make the US look approximately $800 billion richer, potentially alleviating investor concerns about our national debt. However, there is a significant risk involved. If the value of gold falls below this new valuation, investors will be even more anxious about the situation because it would put us underwater on those assets. We know that gold prices don't always rise. For instance, from 2008 to 2012, gold prices surged as people worried about inflation and an economic crash. However, when those fears eased in 2012 and the economy rebounded, gold prices depressed significantly, not reaching new highs until 2020, nearly a decade later, when similar concerns about the dollar resurfaced. It's essential to note that gold, as an investment, does not generate value in the same manner that stocks do. Companies like Nike manufacture shoes, McDonald's produces burgers and develops real estate, Amazon sells products and services through AWS. Gold merely sits there, offering no intrinsic value or production. This is why gold is labeled a debasement trade. People typically invest in gold when they fear the dollar's value is decreasing or other economic concerns arise. They're purchasing gold as a form of insurance. When that insurance policy, that hedge, grows in value faster than other assets, it raises alarms. Additionally, we're observing that the Trump administration is making changes within the cryptocurrency landscape to also improve perceptions of the national debt. In March 2025, President Trump signed an executive order that established a new strategic Bitcoin reserve and a broader digital asset portfolio. This initiative doesn't mean the US government will begin buying Bitcoin outright. Instead, when the government seizes crypto assets, rather than selling them as they did in the past, they would retain ownership of the Bitcoin. This means if Bitcoin's value appreciates, the government boosts its perceived wealth due to increased assets on its balance sheet. Why does this matter? Over the years, the government has seized about 170,000 Bitcoins, which they previously sold off. If instead, they had kept those Bitcoins, they would be worth significantly more today. When Bitcoin reaches values of $80,000, $90,000, or even $100,000, it makes a substantial difference. The government plans to hold on to such assets, because if Bitcoin continues to rise, it enhances the government's perceived value, making the national debt appear less daunting. However, if they hold on to Bitcoin and its value drops, it creates complications. For instance, if they record Bitcoin at $100,000 per coin, and then its value declines to $60,000 per coin, that will make the government appear substantially worse off, especially if they've borrowed against those assets. Now, what does this mean for you specifically? Should you invest in gold? Should you buy cryptocurrency? Perhaps. Personal finance is individual. There's certainly a place for gold in a portfolio, as well as for crypto. However, the proportions will differ from person to person. What's crucial to grasp here is that the trend is not shifting. The US government continues to spend more than what it collects in taxes, impacting everyone. When more money is printed, usually, one party becomes wealthy. It's not the workers, it's the investors. How do I know this? Just look at the last 5 years where we've witnessed investments grow at a rate far exceeding wage increases. The median household income has increased by less than 25%. Estimated at around 22% over the past 5 years, while the stock market has soared by roughly 90%. This pattern represents the ongoing trend we've observed for decades. Therefore, if you aspire to build wealth in this economic system, relying solely on your salary will not suffice. I'm not implying it's wrong to work. Earning a salary is certainly not a bad thing. However, it is imperative to allocate a portion of that income towards assets. What are those assets? They include stocks, real estate, particularly rental properties, along with cryptocurrencies or gold. There are various avenues available for investment. Yet, it's essential to own these assets because as more money enters circulation, inflation occurs. Consequently, consumption becomes pricier. You visit Amazon and spend more for goods. Go to Kroger and pay more for guacamole. You go to Walmart and find that everything is more expensive. In turn, more funds tend to flow into the hands of investors rather than workers, who typically see only marginal wage increases. This demonstrates the incomplete max_output_ tokens. Every time gold prices exceed the stock market, two things occur. First, something in the economic system breaks down. Second, specific individuals become extremely wealthy. We're witnessing this right now. Let's take a closer look. In the past century, gold prices have only surpassed the stock market on 5 separate occasions. The first instance was in the early 1930s, coinciding with the Great Depression. The second occurred in the early 1970s, when we experienced severe stagflation, marked by soaring inflation, falling wages, and a significant recession in the United States. The third instance was around 2000, when the dot-com bubble burst, raising concerns about the economy and the dollar. The fourth came in 2008 during the significant financial crisis marked by a housing market crash, and worries about hyperinflation due to extensive quantitative easing. Thus, gold prices outpaced the stock market. The fifth instance began in 2020 during the pandemic. You might ask, But didn't we already see that pressure? The pandemic led to an economic shutdown that caused widespread concern. Here we are in 2025, and gold prices are once again exceeding the stock market. History may not repeat itself, but it certainly expresses similar patterns. Each time this has happened, it typically indicates bad news for the economy while some individuals become exceedingly affluent.